the last thing I should say is a management representation letter. And this is, excuse me, kind of a big deal. It is basically all those things that you relied upon during the audit and assertions and so forth that were made by management. You take those and you put them into a letter and you have them sign it. Now, usually it's signed by the CEO and CFO. The representation letter. Does not replace audit evidence. What I mean by that is it doesn't count, you're going to get all the evidence to support your opinion, whatever your opinion is. But the management letter does not make up for any lack of evidence. You have to have enough evidence on your own to support that. What was really happening with this management letter is it's sort of reminding management, and it's putting into writing those things that you relied upon for them. And a lot of times people will tell you things, you put it in writing, and they don't want to sign it. And that's kind of what this is all about. It's like, well, have you told us everything? And so the management letter is really there more for corroboration that that they have given you everything that they need to. Now, if they don't sign the management letter, the immediate question is why. So if you hand them the management letter and one or both of them refuse to sign, the immediate question is why, and that raises doubt about what's in that letter. So if there's something that they told you that you're relying upon that they don't want to sign to, all of a sudden there's that doubt. And so it is possible that you give them a disclaimer of opinion because you don't know. You don't know what the reason is for them not signing this letter. And if they refuse to sign it, you can just tell them that, look, if you don't sign this, you can get a disclaimer of opinion, which is basically nothing. So, stupid phone. I don't know why it tells me stupidest alerts. I tried to turn them off, but anyway. So the management letter is really there to sort of remind management of this is your responsibility. These financial statements are your responsibility, and that you've provided us with all the information we need. So the kind of things that go on there, and this is they test us. When I was going through, they didn't test it that much, but nowadays they kind of, at least in the reviews, they test it a little bit more. Okay, one of the things they typically put in those letters is that they have provided access to all the information to the fair presentation of the financial statements and records, documents, and blah, 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 you requested for the purpose of the audit. In other words, have you given us everything? One of the reasons why you do it is to reduce the misunderstanding. So you put it in writing and see if it's exactly what that you thought it was. Okay. The management letter is dated at the last day of the audit. It's on the audit report. In other words, the last day of field work. And this is basically so that it matches up. If you gave it to them before then, things could happen in between the date of the letter and the date of field work. So this is one of those last things that you end up doing. Okay. I can read that. can include the same as violations or laws, regulations. So basically, you're saying that they disclose that they have told you about any possible violations of laws. That's just, and actually, if you're doing an audit of someone who does a lot of government work, like military contractors and things like that, they will they have a tremendous amount of auditing that goes on between them and the government for all these contracts that they have. And so those become, it becomes a really big deal on those, that they are actually, that they're, let me turn this thing on. So let me turn it off. Okay. In the materiality on those contracts, by the way, becomes a little bit different too. Just so you know, if you're dealing with a government agency, materiality is per grant or contract. So you talk about someone like General Electric that may have dozens or hundreds of contracts with the government. Each one of those contracts, the materiality is within the contract itself. So if it's a $10 million contract, you have materiality based on $10 million, not on $10 billion of General Electric, revenues. You have it based on whatever that contract is. So it's a much smaller based on those contracts. Yeah, so those would certainly be something you'd put in there. Has no knowledge of any fraud or successive fraud involving management. Now, you generally don't put looking for all fraud, but you're talking about senior management, that they have no knowledge of any fraud or suspected fraud. And if you recall, management, especially upper management, and what they call it here, senior management, that if they're committing the fraud, it's a bigger deal than if someone lower down in the ranks is committing a fraud. Someone higher up committing a fraud means you can't rely on the upper management. That's a problem. Lower level fraud, it doesn't have that big of an impact. It doesn't have as much of an impact on the financial statements, and you don't usually rely on those people. If there's someone on the loading docks that's doing some kind of fraud, you're really not going to the guy on the loading dock and asking him about the depreciation tables or something. So they generally don't. It's who has the ability to change the financial statements is what you're really looking at. And if there are people committing fraud who are also have the ability to change the financial statements, that's the problem. So when you do ask about fraud, you're asking about the upper management, because especially the people who can have an influence over the financial statements. Okay. Related parties. Just so you know, related parties are it can always be a problem. Related parties are when it can happen a few different ways. It could happen between owners. It could happen between people in management, or just people who are involved in the company, and that they have a transaction with the company. So, for example, if you had, let's say that the controller bought a piece of land from the company. Now, maybe it was at market price or whatever. You cannot put that in the financial statements that this was a fair value transaction, unless there's concrete evidence that it was a fair value transaction. If there was a public auction or something like that, and the controller happened to win the auction, that's one thing. But if it was just a deal between the company and the controller, you cannot put in the financial statements that is a arm's length transaction. That's a fair transaction, fair value transaction. But you do have to disclose it. So related party transactions, you have to disclose. So if they sell, whatever, if they sell a building or something to a large shareholder, same thing, is related party. You put it in the financial statements, they cannot put in there that this was a fair transaction. Like I say, unless there's specific evidence that it is. For instance, if someone bought stock at the stock price that day on the open market, well, that's, that would be an arm's length transaction. But unless there's that concrete evidence of it, you cannot put it. They cannot put it in those notes to the financial statements. Okay, and they cover all periods covered. Okay, and again, so it's actually a fairly important document. And again, if they don't sign it, I should put that in somewhere. I'll put it in here. Now, most people who, especially for like publicly traded companies and things like that, they're definitely going to sign it. And by the way, even if it is someone who's only been, someone, well, I've only been the CFO for 2 months, so I'm not going to sign that. They have to. If they don't sign it, like I say, the disclaimer is, if someone refuses to sign it, that is enough to give them a disclaimer, because you don't know why they're not signing it. Now, it may be true that that person's only been there for 2 months, but they should be able to get enough of a feel for what the company's doing in that 2 months, especially the chief financial officer, to know if those financial statements are fairly presented. Okay. Lawyer letter. I don't know if I have it in here. The US rules, it is required. International rules, it's not required. International rules are such that you usually don't have these huge lawsuits like we do in the United States. One of the things in the United States that we have that a lot of other countries don't really have is the use of the punitive damages. The actual damages were whatever, $3 million. That's very common. That's common all over the world. So, the actual damages are in there. Now, punitive damages, that's where the big dollars come in. And a lot of times those are the ones that say, okay, the actual damages are $3 million, but the punitive damages are $68 million. Those are the kind of lawsuits we have in the United States that they don't have anywhere else in the world. So United States, because it's more likely to be material. Talking to the lawyer is very important. So the lawyer letter is actually very important for the audit in the United States, anyways, because the liability could be huge on it. Okay. The auditor first obtains information. This is one of those. This is a good CPA question. The primary source of information comes from the client. So it does not come from the lawyer. That information is then corroborated. So if the client says, okay, it looks like we're going to lose, $300,000 on this case, it should be corroborated by the lawyer letter. So your primary source, though, is the client. And the corroboration is received from the attorney. This is also a weird one about it. This is a strange thing about the lawyer letter. And I think it's the only time that we actually have this. Generally speaking, you do not tell the client what your materiality is, and for obvious reasons. If you if you tell them that, look, materiality is 500,000, what the client's hearing is, oh, we can cook the books for 400,000 and have no problem. So you don't tell them what the materiality is, and they could also, if they are doing something fraudulent, they could modify whatever they're doing to try to avoid being caught. If you're looking for $500,000 errors, they make them a bunch of little ones or whatever. Okay. And the understanding is then communicated to the attorney, who will limit his response accordingly. Okay, so it wouldn't be uncommon to have dozens of lawsuits. I mean, you can imagine some company like Walmart. How many times do people fall in the parking lot in Walmart? How many do they fall in the store in Walmart? People get hit by a forklift in Walmart, whatever. Every day there could be dozens of lawsuits that actually spring up. And probably most of them are, $1,000, $2,000, $3,000. But there's also probably going to be $100 million, $200 million, $300 million lawsuits for Walmart. Now, if you go to the attorney and say, okay, let's see all the lawsuits, they're probably not going to deal with you, because it's like, the amount of lawsuits, the total amount of lawsuits is probably pretty high. Whereas the materiality, the material ones are probably fairly low. They're not probably, I don't have that many $100 million lawsuits. $1,000 lawsuits, they probably have hundreds of those, but as far as the big ones, they don't. So you got to come to an understanding with the client. Now, usually the materiality you're talking about is going to be lower than your overall materiality for the financial statements. But you're gonna say, okay, we're only looking for lawsuits that are, if it's Walmart, 100 million. If it's for something smaller, whatever it is, just so the lawyer knows, well, what do you want information on? Right? You have to tell me what you're looking for. How big is it? Blah blah blah. Controls. Reading the minutes of the meetings. Oftentimes, if there is a lawsuit going on, if there's a proposed settlement or something like that, it'll be in the minutes of the meetings. I think we talked about this. What are the minutes of the meetings? We talked about this? I think we did. Maybe we didn't. Oh, I guess we did. Who knows what the minutes of the meetings are?
Isn't that like notes that they take down for the meeting?
Exactly. These are just the notes of the meetings, and especially of the board of directors and some of the higher ups in management, if they have meetings that are there. Because a lot of times they will identify, especially big lawsuits and things like that. Here's a proposed settlement. Well, we have to run it by the board of directors to see if they agree with it, that sort of thing. So the minutes of the board of director meetings should always be read by the auditors. A lot of times the auditors will be right in the board of director meetings. You'll have the board of directors, and you'll have a couple people sitting around taking notes, or I don't know, playing with their phones or something. But those are the auditors, and they're often invited to the meetings, whether they show up or not. But a lot of times they'll be right in the meetings themselves. And the whole idea is, and by the way, they just sit there usually, and they don't obviously participate. They're not members of the board of directors. But the idea is, look, they're going to ask about stuff anyway. So if they can hear it, it saves a step in explaining it and all that kind of stuff. So anyway, they'll get the meeting, the minutes from the board of directors, but a lot of times the auditors themselves will be sitting right in the meetings. And if they do not let you talk to, that's a little bit. A little green goes a long way. Yeah, we'll do this. The refusal of the client's attorney to provide information requested is considered a limitation on the scope of the audit. It would result in a disclaimer or a qualified opinion. Now, usually, if the attorney has a lick of common sense, they're going to comply with it because the client's going to ask them to comply with it. But if they refuse, it would result in a disclaimer or a qualified opinion usually. So if, again, it's that thing that if you don't know, these could be material things, and if you don't know, you're prohibited from giving them a clean audit opinion. Now it might be that you get some inkling and that you give them a qualified, saying, look, everything's okay except for this litigation that we can't verify. But you could also just give a disclaimer. Now, why I say if the attorney has a lick of common sense, the attorney is under the same professional standards that the auditors are under, in that they have a fiduciary duty to their client. And if their client is given a bad report because of the attorney leaves themselves open for a lawsuit. So if a attorney just by themselves refuses, that is a problem, and they could lose their license for it. Now, if the client refuses to let you talk to the attorney, that's also a problem. Same thing. Well, why are they letting you talk to it? It immediately raises the concern of there's a reason why they don't want us talking to the attorney. So, but if the attorney themselves refuses to cooperate, then disclaimer, qualified opinion. Okay, and a lawyer may limit their responses to only those things that they've worked on. For instance, if there is things like unasserted claims, no one has made a claim, that someone falls in Walmart, no one's made the claim. You don't ask the attorney about that. They have no idea, and they haven't done any work on it anyway. So it's only those things that they are actually working on, are those things that they are. You don't ask them hypothetical questions. Well, what about if this falls into the river and then a wave comes up and knocks people down? It's not their concern. It's only their concern about the stuff that they are actually working on, and they will limit their responses to those things. And you do not confirm that all the claims have been recorded in the financial statements. Again, this is something the attorney would not know. So you do not do a confirmation that everything has been reported in the financial statements. Now, you could do that with management in the management letter. The management letter that all material claims have been put in the financial statements, but the attorney is not on the hook for that. They'll give you information that they know about the cases that they're actually working on. All right, any questions there? Okay, communicate misstatements to management. Management should be aware of actual misstatements. So actual misstatements are different than projected misstatements. Too many ATs in there. Projected misstatements are only communicated when they are material. So there is a difference between actual misstatements. I do here. Actual misstatements and projected misstatements are two different things. If you think about when we did this sampling stuff, you find that these accounts, this account is off by $400. Now, when we project it, maybe it says that the financial statements are misstated by 20,000. But the account itself is only off by, say, 400 or something like that. A lot of times, even if the projected misstatement is not material, it's sort of a common courtesy to give the actual misstatements to the client because they may want to correct their records. Oh, by the way, this client, this customer of yours only owes you this, owes you $400 less, and this customer of yours owes you $6,000 more, or whatever it is, so that they can actually do those corrections of the book. So misstatements that are communicated, material misstatements, the projected ones, those are the ones, only if they're material, generally do you talk to them about it and say, look, we did our testing and we're 99% sure that these are overstated by at least, whatever dollar. Whereas the actual misstatements are really corrections that the client could make to their books. Sometimes the clients will ask for all of them, say, hey, give us all the misstatements, whatever they are. We want to get as accurate as possible in our accounting and all that. Sometimes if it's not material, you don't bother with it. And again, the client won't bother with it. And again, if they don't make the correction and it's not material, they have an account that's off by $400 and it's not material, you don't do anything with it. It's up to them whether they want to correct their books or not. But oftentimes they will want to know what the actual are. A sneeze. Okay. Review of the engagement. Oops. The audit reviewed by audit manager, oops. And usually at least one other, another partner that is not associated with the audit. So usually it's reviewed by at least 3 people. Sometimes, especially for the publicly traded companies, they will have an outside auditor review it. There's a designated outside auditor who's not part of the firm itself who will go over it. And the idea is that you want to have people who are familiar with auditing, who know what they're looking for, go over this and make sure that there's nothing that people aren't missing. Even though the manager went over it, manager knows all about auditing, the partner went over it, they know all about auditing. It's good to have that other person in the firm or even someone external come in and review it. Now, here's the interesting thing. For the AICPA, for quality control, you can have the audit reviewed after the audit report is released. For publicly traded companies, the review must happen before the audit is released. So there is actually a time, kind of constraint. You have to get somebody in here to look at this thing fairly quickly because, whatever. IBM wants to get their financial statements out. You can't have somebody who sit around for 2 months, waiting to review this thing. So let me put that down. So for non-issuers, so non-issuers may have their review after the audit report is released. I don't know what that was. Obviously, I copied something. Issuers must have the review before the audit report is released. So this is AICPA stuff. Hey. And this is PCAOB stuff. So a review must happen. Can it happen after the audit report is released? And this is for quality control. PCAOB, it must be done before the audit report is released. And again, this makes it, you're trying to get this report out as quickly as you can. So you got to have these reviewers set up and ready to go. Okay. Other information in the audit report. So it is possible. I'm not sure what I have that there for. I was thinking this was something different than I was. Other information in the audit. I'm not sure what that is. You do have the ability to put other information in the audit report. We'll actually we're going to do the audit reports next chapter, so we'll talk about that. There are critical audit matters and key audit matters that we'll put in the audit report that are additional information. I imagine that's what I was getting at on that. But basically, so you're wrapping it up. So basically, you'll then at the end you'll take all the evidence. From an audit opinion based on the evidence. And the opinion can only be based on audit evidence. It can't be based on anything else. So if they're missing some kind of evidence, they can't go back and point at the management letter and say, well, we put that in the management letter, though. It can only be based on the audit evidence. And usually what they'll do is they'll go back, they'll take all the information, go back to the CPA firm and go through everything that they have. And base the audit opinion on that. All right. Yeah, I think this is for, oh, we'll talk about it next. Okay, so skip this one. All right. Let's jump into the 17 handout. All right. So chapter 17 is all about the audit reports and the opinions that we have that we form on those reports. So this is sort of after we get all the evidence, we go back and we make our reports. And reports come in really three flavors, four flavors. Unmodified opinions, those are the clean audit reports. Oh, wait a minute. Okay, it's gonna be a while. And then the modified opinions, which there's three of them down here. I guess that's quite a wait. So 7 pages later, sorry about that. Unmodified opinions. Okay, the unmodified opinions are the clean opinions. That's opinion you get for the, and that's what most of the time you're going to issue. The unmodified opinion is issued 99.9% of the time because for publicly traded companies, it's virtually 100%, and it's less than that for non-issuers. But it doesn't do a client any good to get anything less than a clean audit report. If they get a qualified report, the qualified report is going to have the dollar amount that the report is, that their financial statements are misstated by. Now, notice that makes them look bad. The audit report will have right in it what they're not being truthful about. So usually you tell them you're getting a qualified opinion, an except for opinion. They'll say, well, we can't get that, well, then make the change, and, or else this is what you're getting. So usually they see the light, and so the modified opinions are actually pretty rare. And especially, the adverse opinion, which is the worst, it says don't rely on these financial statements. It gives the dollar amounts. So if they think that they're going to hide a $5 million loss, it's going to be right in the audit report. They're not going to be able to hide it from anyone. But what it will do is highlight to people that, hey, these people are not being truthful. And as you can imagine, if you're trying to get money from the bank or investors or something like that, that's a big no-no. So they're very rare to get the modified reports. And the disclaimer too, it doesn't do the client any good to get those. So usually people, companies and whatever will change what they need to change to get a clean report. Okay. Now, does it happen? Yeah, sometimes it happens. You get people pounding on tables saying, "Well, yeah, I'm not going to do that. You can't tell me, blah blah blah." And all of a sudden, you get a bunch of adults that just wasted a bunch of time and money, for nothing. So, does it happen? It happens, but very rarely. Okay. Unmodified standard report. So what must you have before you can give a unmodified report? Complete set of financial statements. Management must take responsibility for the financial statements. The auditors are not responsible for the financial statements. The auditors are responsible to give an opinion. Management's responsible for the financial statements. In terms of the engagement, this is sort of like this is usually the kind of stuff you'll see in the engagement letter. The auditor has concluded that the unmodified opinion is appropriate. This is kind of a wacky one. And that the entity is going to continue as a going concern for a reasonable period of time, and we'll talk about this in a second. They can actually get a clean opinion if they are even if they're going bankrupt. But there's a bunch of different conditions in it that you have to go through. Now, I'll show it to you in a second. I didn't obtain other information prior to the I'm not sure what that one is. The auditor has not been engaged to communicate key audit matters. We'll talk about all these in a second. So these are kind of wacky, but I want to show you something about this going concern. And then this is actually kind of a one that's kind of taken on a life of its own. And the question comes up: can a company that's going bankrupt, can they correctly prepare their financial statements? Let's say they're doing, poorly. Can they make their financial statements, present fairly their position? Now it's going to look bad, but can they do it? Can they make financial statements that, present fairly with the condition the company's in? What do you think?
Depends on how well they can cook the books.
Well, like I say, do they? I mean, is it required that they would have to cook the books? I mean, they could just say, "Look, we're losing a bunch of money here. We have this loss and all this kind of stuff." Just because they're going bankrupt does not necessarily. Now, it does mean that there's a bigger risk that they have more incentive to cook the books. That's true, but they could also make their financial statements, fairly presented. They could also say that fairly accurately make their financial statements. Okay, so this raises the question though, and this is what was happening that people were getting mad about. You hear like on the news or something. This company went bankrupt just 4 months after getting a clean audit from their CPA firm. Well, their financial statements were fairly presented. People thought that like a CPA firm was saying, "Hey, here's a stamp of approval. This is a good investment," which we never do. We never say. In fact, it's against the rules to even say that. If I'm the auditor of IBM, I can't go around saying, "Hey, IBM is a good company to invest in." You can't do that. That's advocating for your client. So, not only don't we do that, it's prohibited for us to do that. You're no longer unbiased. So, but there was this gap that people had this expectation that an audit report meant something that it really doesn't. And it was, a lot of people thought that. A lot of people thought the audit report meant that this company is okay. That, oh, look, we got a clean audit report, and people invested. So they kind of came up with, to try to kind of close that gap, they came up with this idea of putting an extra paragraph on a going concern. Now, a company can still get a clean audit, but they will tack a paragraph on that says a going concern. Now, if the company is bad enough, if they're in rough enough shape, it might change the way they do the accounting. You know, does it make, if a company looks like it's going to go bankrupt in the next year, does it make sense to depreciate, depreciate assets over 10 years? Well, no, it's probably going to be sold off in the next year. So rather than depreciate over 10 years, you might put it on the books for what you think it's going to sell for. So you can't, it is possible that you change your accounting method. You go from GAAP to what they call liquidation method, or whatever, whatever method that seems appropriate for the company. So it is possible now even changing from GAAP though is okay. You can get a clean audit using a different, you can use a cash basis or modified cash basis or whatever, and still get a clean audit report if you state it right in the on the financial statements that these are modified cash basis or something like that. So as auditors now, though, we have to determine whether this company is going to last for a certain period of time. It used to be within the next year. The new rules are the time frame has to be at least a year. It might go into 2 years or even more. International standards are 2 years. US standards are 1 year plus, could be 2 or 3 years or whatever. So this going concern thing is actually, it can be kind of tricky to get into for a couple of reasons. One of the things that a lot of times companies that are going bankrupt are starting to make plans for how to save the company. So if they have a plan in place that looks like it's viable, it looks like they can do it, it is possible that you don't give them a going concern if the plan is, they have the ability to go ahead with the plan. And it looks like that plan itself will work out for them. I remember there was a case, an airline got a going concern, a small airline got a going concern, and the management came out and said, we disagree with the auditors. We're slashing, this many jobs, we're selling these routes, and we're, concentrating on this and that. And the auditors replied that if they had those plans in place when we did the audit, they wouldn't have got a going concern. So sometimes it's a wake-up call, like, yeah, you guys aren't going to be around very long if you don't do something. So anyway, the going concern thing. Now, I sent out a share my screen above. This is the actual. This is what the AICPA stuff looks like. So I sent this out. This is AU section 570. And this is all about going concerns. And just to let you know, when I was going through it, it was about 2 paragraphs. Now it's 52 pages. And you can go reading through all this stuff. It's become quite a bit more involved. But a lot of times you go through here, for instance, we just talked about this, is the going concern basis of accounting inappropriate? If they're not going to be around, it doesn't make sense to depreciate this over 10 years if they're not going to last for 2 years. So it covers a lot of stuff. It covers, what evidence do you need? Eliminating a going concern from a reissue reports. But you gave a going concern opinion, and it turns out that they're doing very well now. What do you do with that? You got this going concern from a previous report, and you need to take it off. So there's all kinds of evidence in here, or evidence, I should say, rules in here on it. And like I say, you can, now on the CPA exam, they're just going to hit the highlights of this. But yeah, you can kind of see the kind of the level of rules in that they're going to. It's a really big thing now. Okay. You know what? Let's stop here. Was it 6:52? All right. We'll come back and get into the audit report itself. Okay. Hey, what did I do here? 7:02. Okay. I just want to talk about two more things about the going concern, and then I'll be quiet about it. It is possible that you have a client that may go bankrupt because of the going concern paragraph. You know, it may be that they say, look, if you put that going concern paragraph on the audit report, we are going to go bankrupt because no one's going to lend us any money. So you do have this problem too, that the audit report itself may cause or be partially the cause for the bankruptcy. And another concern is that if a company goes bankrupt, you know, who's going to get sued? Hey, if a company goes bankrupt, who's going to get sued? The company? They're bankrupt. They don't have any money. The only people left with money are the auditors. So a lot of times lawsuits will, you know, if they do come, usually it's going to be somebody who feels they've been wronged, and the only people that are left to sue are the auditors. So it's a real problem when you have a client that's going bankrupt, especially if you have a client that was profitable and then became financially unstable, because it's difficult to leave a client like that, because you can't leave them in a worse situation, you know, than when you found them. Basically, is sort of the rules to it. But they, you know, generally they have to be able to get other auditors to come in. And as you may well imagine, when a company is going bankrupt, it's hard to get auditors to come in, because there's this liability that increases, even if they do everything, you know, right down to the letter. If the company does go bankrupt, they're one of the people that can be sued. They're one of the groups of people that can be sued. So it is a very risky proposition. And now, if they're going bankrupt and you know they want to use a new client, you can walk away from it. But if it's a client that you've had before and that they've been unable to get some other auditors to come in, then it can be a problem. Okay. Audit report. When I was there's some ancient history. When I was going through, one of the hardest things that people had to do for studying for the CPA exam was you had to memorize this audit report, and you memorize it verbatim. It's longer now than it was. It wasn't quite this long when we went through, but it was a little bit late, probably like, I don't know, half as long. I don't know. But anyway, you had to memorize it. And you had to memorize it because the CPA exam back then, they would say it, right? You know, one of the things that they could ask you to do on the auditing section was write the unmodified, or it was unmodified back then. It was called unqualified. Write the unqualified audit report or standard audit report. And if you memorized it and you wrote it, you probably passed the exam. If you didn't memorize it, you didn't. So you memorize the audit report. Another thing that was very common they would do back then is give an audit report that's kind of mixed up a little bit. You know, they'd have wrong words in here and there and all that, and you had to find all the wrong words that they had in it, so you'd memorize it. And like I say, if you memorized it, then you could figure out what was the wrong words and all that kind of stuff. But one of the reasons why we also go through it, though, we don't memorize it these days, and they don't tell you just to write it from memory like they used to. But one of the reasons why you do want to go over it, though, and to think about the audit report, is that audit report really contains basically everything required in an audit. It talks about evidence, it talks about materiality, it talks about judgment and all these other things that go into it. And a lot of times you're running into questions, especially on the CPA exam. The CPA exam, when you take it, you're going to run into a number of questions that you have no idea, you've never seen before. You know, you went through the audit review, whoever's audit review it was, it wasn't on there. They just, it happens. And you should be okay with that. You gotta be okay with that. You can't, stop and spend 10 minutes looking at something that, you have, you're not gonna figure out. But one of the things you can think about though is the audit report. Those things that are on the audit report are the things that are important. So if whatever the question is, if you can relate it somehow to the audit report, like would this be important in the audit report? A lot of times you can come up with some kind of an answer to it. So one of the reasons why we look at the audit report and why it's a really good thing to, at least the highlights in it, to kind of memorize those highlights, that when you do run into questions that are difficult, you can run into a question that it seems like there's two right answers or something like that. Think about the audit report. Which one of those questions would be more appropriate, answered on the audit report, whether it's in whatever the question is. So the audit report is the end result. It's the finish line. And so it's a really good place to kind of get more of an overall view of what you're doing in auditing. Okay, so this is the audit report. I wonder how this labeled. This is for the AICPA. This is for non-issuers. And why I don't have that labeled, I have no idea. Maybe it was a spacing thing or something. Okay, so this is the independent auditor report. You write on it independent. Now, who is it addressed to? We address this thing to shareholders and the board of directors. We do not address it to management. Why don't we address it to management? We're addressing it to the shareholders and the board of directors, not to management. Why not? Who made the financial statements? Management. You're not going to tell management about something they've already should know about. So this is for people on the outside. So what is audit report aimed at? It's aimed at people outside of the company. So these are people that are outside the operations. That's who you address it to. Oops, I didn't mean that. So shareholders, board of directors, these are people that are not daily, they don't make the financial statements. They are people that need to know if the financial statements are can be relied upon. Okay. They used to put the opinion at the end of it. Now they put it at the front. We first have an introduction of what did we do. We audited the financial statements of ABC Company. We tell them what financial statements we looked at. Balance sheets. You might wonder why it has an S there. It's possible that they have consolidated financial statements. Statements of income. Stockholder equity could also be retained earnings statement, and a statement of cash flows. So those are the four financial statements. So balance sheet as of December 31st, or whenever their year end is. And the statement of income, changes in equity and cash flows for the years that ended. And the notes to the financial statements. So what they put in the notes to the financial statements, in the past, it was always assumed that, that the notes go along with the financial statements, but now they put this right into the introduction of it. Okay. In our opinion, the financial statements present fairly in all material respects. We never say that they are accurate or anything like that. We only talk about material aspects. The financial position. Financial position is another word for balance sheet. So financial position is another word for balance sheet. Results of its operations. This is the income statement. Cash flows or just cash flow statement. Okay, so we say, in our opinion, in all material respects, that these financial statements are presented fairly. Then, in accordance with the accounting principles generally accepted in the United States of America. So this is GAAP. Or generally accepted accounting principles. So this is, and again, these are the accounting principles, not the auditing principles. These are accounting principles. So the financial statements are made to accounting principles. So this first paragraph, this opinion paragraph, this has, first of all, the opinion. And, they tell us about on the opinion on the financial statements. And then they tell whose rules we're using. Now, if they didn't use GAAP, let's say they use modified cash basis, that would be changed to, instead of saying that these are in accordance with, accounting standards, for the USA, it would say modified cash basis. So you can do an audit on something other than GAAP. You can do cash basis. Sometimes you'll have people that do it in according to the IRS rules. Why do they do that? It's small business. They do it to the IRS rules because they're going to take those same numbers and plug them into their tax return to file that. But you can audit that to the IRS rules as far as what income determination or whatever. So you can do it to other standards. Now, if you do that, you have to explain it later, and they have to put footnotes in for it. But you can do an audit for the AICPA. You can do an audit to, they used to call them ACBOAs, other comprehensive basis of accounting. I should put that down. So ACBOAs are other comprehensive basis of accounting. And again, a lot of times it'll be the cash method or the IRS method. There could be other methods too. But if you hear someone talk about a NACBOA, they're talking about a different method other than GAAP, or the generally accepted accounting principles. Okay, so this is, the opinion is on the financial statements, and whatever standard you are auditing them to is also put in that opinion. Basis for our opinion. Now, remember, we're getting all the evidence, and so we'll talk about this. We conduct our audits in accordance with auditing standards except in the United States of America. Now, notice the difference. These are the auditing standards. So the accounting standards are in the opinion. The basis for our opinion has the auditing standards. So go with the auditing standards. And it goes on to talk a little bit about those standards that are discussed later on. We'll talk about these, the auditor's responsibility down here. We'll talk about it. But it comes out and says we are required to be independent. So that independence is a big thing. We believe we have obtained sufficient appropriate evidence from a basis for our opinion. So the only thing that we can base our opinion on is evidence. Nothing else. Okay, so evidence is the only thing that we can base our opinion on. So far we've told people what our opinion is. In this case, it's a clean opinion. We've told them what rules we're following. We've told them that we're independent from the company. And that we have only based our opinion on audit evidence, nothing else. You know, it's not a promise by management, not a gut feeling or something like that, but we have evidence to back up our opinion. It's an opinion, but it's not, just because it's an opinion doesn't mean it's weak. If I say, like, in my opinion, blue is the best color, that's different than this. This is an expert opinion. This is opinion that has some backing to it. So even though it is an opinion, it's not a statement of fact. We don't know for a fact that the statements are free of material misstatement, but it is an opinion, but it's an opinion that's backed up by evidence. The evidence has formed our opinion. So while saying, well, geez, an opinion sounds kind of weak, it's not an opinion on, what's your favorite movie? Okay. Responsibilities for management. So we basically gave our opinion, we gave a basis for our opinion. Now we say management is responsible for the financial statements. The auditors are not responsible for the financial statements. So management Oops. All right. Now, we talk about this, the going concern. So this going concern thing, I see when I was going through, it was kind of a minor item, but now it's picked up more steam. I'm gonna do something here. I realized I probably took this out because of spacing. Okay, auditor's responsibility. So we now know what management's responsibility is. Here's management's responsibility. Auditor's responsibilities are what? Our objectives are to obtain reasonable assurance about whether the financial statements as a whole are free of material misstatement. Again, we don't say all misstatements. This one is fairly new, whether due to fraud or error. It's always been assumed that we meant both, but now we spell it out. And include an audit report and issue an audit report that includes our opinion. So we're required to do our audit and to issue an opinion. Now we go on to say reasonable assurance is a high level of assurance, but not absolute, and therefore not a guarantee. So we do come right out and say, look, you know, it's high level, but this is not a guarantee. An audit was conducted in accordance with GAS. This is the auditing standards. And again, we're saying it's not a guarantee that they'll always detect material misstatements when it exists. A material misstatement when it exists. So we come right out and tell them, look, you know, this isn't 100%. It's a high level, not 100%. Okay. This is a very important statement. And this is why fraud is such an important part of what we do. The risk of not detecting a material misstatement resulting from fraud is higher than that resulting from error. Why is that? You know, why is it more difficult to detect a fraud of $5 million than to detect an error of $5 million? Both misstatement of $5 million. Why is
usually fraud? Usually when it's fraud, they're working on hiding it. Where if it's an error, it's just a simple mistake, maybe a number or something.
Exactly. There's a level of collusion involved. And if you guys remember the segregation of duties, you know, that breaks down. Right? I mean, when you have people colluding, those segregation of duties aren't there anymore. And one of the limitations of internal control is management override. Usually, if a company is fudging the numbers, it's not some lowly, accountant who, trying to be funny or something. It usually comes from up above, and that there's some kind of pressure to have numbers and whatever, and that's where it comes from. So they actively are trying to keep you away from it. And remember, when you come in to do an audit, maybe you're there 3 weeks. They're there all year round. And they're smart people. And many of those people were in CPA firms. So you got people who were in CPA firms who have all year long to figure out how to do something and keep it from you. It's a very daunting task. So for that reason, it's much harder to find fraud. And at some level, you do have to trust management. That goes out the window when there's fraud. And on some level, you have to trust that management is, you ask them for stuff, that they're giving you the stuff that you need. And I'm sure that, they know what you're going to ask for a lot of times, especially if it's a publicly traded company. They know what you're going to ask for because they've been on that side of the table before. So it's very difficult when you have people who know what they're doing and who are actively trying to hide it from you. So it can become very difficult to find it. Whereas, like you're saying, a fraud, an error, if someone puts in, someone buys a calculator and puts it in for, instead of $6, they put it in for $6 million, it's going to hit somebody's budget. Somebody's going to say, whoa, what's this? Why do we have a $6 million calculator? And it's going to be caught probably pretty quickly. Whereas someone's actively trying to hide things like that, it becomes much more difficult. And again, you're not talking about people who are bumpkins. You're talking about people who know what to do, especially for instance, for larger companies, publicly traded companies. They probably came out of, auditing. May involve collusion. Again, this breaks down those segregation of duties. Forgery. And intentional omissions and misrepresentation. So these are all reasons why it becomes more difficult to find it. When you have people actively trying to hide something, it makes it much more difficult. So a lot of times when there is a material misstatement in the financial statement, it's due to fraud. Why? Because if it was a simple error, they probably would have caught it already. So if there is a material misstatement, a lot of times it has to do with fraud. Okay. And they go on to say what are material. So they talk about what is material, and that it would influence the judgment of a reasonable user. It's kind of like the they used to call it reasonable man. I guess now it's a very reasonable person. In law, they would say, what would a reasonable person, do? And you'll find the same thing with financial statements. There's some people that think the financial statements should be accurate right down to the penny, whether it's Walmart or whoever. And you have people that have unreasonable expectations, but a reasonable person, what would they say? Okay. And by the way, a lot of times people think auditing is that. They think that we audit things down to the penny. But for financial audits, that doesn't happen. Okay, so one of the things we also tell people, and this is one of the areas that I think that we've trying to close the gap on what people know about auditing, of what they expect out of it, is that we tell them right up front that auditing contains judgment, and we also have a professional skepticism. So it isn't that we just believe everything that management tells us. We don't go around accusing them of fraud for no reason, but we also have a professional skepticism that is this actually what we're looking at? So we tell them right up front that there's these two things that go kind of hand in hand: judgment and professional skepticism. And I think I told you before that, if I didn't, I should have, that auditing is all judgment. Everything in auditing is judgment. What's material? It's a judgment call. What kind of sampling method do we use? The judgment call. Do we audit to the 90% or the 95% level? It's a judgment call. Everything in auditing is judgment. And for that reason, it's hard to learn, but also and hard to teach. But also, it's one of the kind of truisms of auditing, in that the whole thing is an opinion. It's based on professional judgment, but it's based on judgment nonetheless. Okay. So we talk about identifying risks of material misstatement, whether error, fraud, what we had before, but also include examining on a test basis evidence regarding the amount and disclosures in the financial statements. So we not only looking for the amounts, but also for the footnotes. And yes, they can have accurate financial statements and have a modified opinion if the footnotes are not. If you actually read through the accounting rules, for instance, companies must disclose in the footnotes their method of depreciation. If they don't, or if they do, if they put in the footnotes something that's not accurate, if you think about it, that is a violation of the accounting rules, and very well could be material. So yeah, company, based on their lack of footnote disclosure, companies could get a modified opinion. Okay, so this one is important. On a test basis, we do not look at everything. Some people think you do an audit that you go through 100% of everything in the company, and you don't. You do it on a test basis. Part of the reason is that you can get very accurate very quickly. You can get to, especially for large companies, you can get to the 99% level by taking a very small sample compared to the total. So on a test basis is, it's an important concept. And part of the reason too is simply the cost of it. When Enron was found to be cooking the books, I think their original audit was something like $4 million or something like that. I can't remember exactly the number, but their original audit was less than 5 million. All right. When they discovered this massive fraud, they had to go through everything. Right now, you got to go through, and you can't trust management. The controller was, into it up to his eyebrows, and very smart person and all that kind of stuff. So yeah, they had to go through everything. And the price tag for the auditors to come in and go through everything was something like 230 million. I mean, it was like a crazy amount of money but they had to do it because, at that point, so you can imagine you can't do that every audit. You can't have every audit cost $230 million. But it was required because of the extent of the fraud and all that kind of stuff that went on. Yeah, so just on a test basis is actually a very important thing. Okay. We obtain understanding of internal control. We're required to get an understanding, and even if we don't rely on it, we have to get an understanding of it. If we rely on it, we have to do the test of controls. Design procedures in appropriate circumstances, but not for the purpose of expressing an opinion on the effectiveness of the internal control. Okay, for non-publicly traded companies, they only have a financial audit. And they don't need to do this. Now, truthfully, even for public trade companies, they aren't required to do the test of controls. Public trade companies, they have to do an audit of the internal controls, give an opinion on that. So they'll do the test of controls anyways. But it is not, we do not give an opinion on the internal control. And accordingly, no such opinion is expressed. So we didn't audit the internal controls and we don't express an opinion on it. And it goes on to kind of clean up. We look for the reasonableness and significance of accounting estimates. And if you think about it, there's a lot of estimates in accounting. What things do we estimate in accounting? Oh, come on.
Depreciation,
Depreciation, look at depreciation.
allowance for doubtful accounts,
Yep. Depreciation allows for doubtful accounts. It could also go into revenue. If you're doing a construction project, how far along are you? Are you 70% along? Are you 60% along? That difference could be millions of dollars and so on. Yeah, so the thing about depreciation, what do we estimate? We estimate how long it's going to last. We don't have a crystal ball. You can't look into go, oh, this is our boat's going to last for 7 years. You don't know how long it's going to last. You don't, and a lot of times there'll be residual value. What are you going to sell it for when you're done with it? That is an estimate. Whether in the life itself, it could be in units, it could be miles, it could be units produced, it could be whatever. It could also be in years, right? So there's a whole bunch of estimates, and any one of those can change a company's income. Accounts receivable is another one. Like I said, estimated accounts receivable. How much of this is going to go bad? How much, how far along are they on the construction projects and long-term contracts and things like that? Those are all things that are estimates. Long-term contracts, even like production contract. They have a production contract for the next 3 years to supply whatever to General Motors. Okay, well, they have that contract, but is that contract going to be profitable? Well, their estimates now maybe say they will be, but again, these are estimates that they're making of how much does it cost to produce these things. If the prices go up, are we going to lose money on this contract and all that kind of stuff? We don't have a crystal ball. We can't look into the future. So those things are all estimated. So there's quite a bit that is estimated on the financial statements. Okay. And conclude whether, in our judgment, again, we tell them it's about judgment, there are events or condition or events considered in the aggregate that raise substantial doubt about the company continues a going concern. So this going concern thing, by the way, when I was going through this, was never in in the audit report. It was kind of this wacky thing you had to check for to see if the company's going to go bankrupt. And again, it was just for kind of narrowing that gap that people didn't like that a company got a clean audit report and then went bankrupt. As auditors, back then it was like, well, we don't make, we just say the financial statements are very, other people make judgments about whether whether the company is doing well or not doing well. So, it was kind of this weird thing, like, well, we shouldn't be doing this, but we kind of have to because people are thinking that we're doing it. But anyway, now it's a very large part. Okay. And we are required to communicate with those in governance. This is basically going to be your board of directors. And audit committee, if they have one. And by the way, governance is a big key term. Whenever you see governance, that means people who are supposed to have oversight of it. So board of directors and audit committee. So governance, those two things are, are key to it. That's what they're talking about when they talk about governance. Oversight. I'll put that in, oversight. Regarding, among other things, the scope, timing of the audit, blah, blah, blah. Significant audit findings. So we tell the board of directors when they have significant audit findings. Internal control related matters, if they're significant or material. We identify during the audit. Internal control matters. Generally, you have to report them if they're significant, which is a lower level than material. So everything they talk about for the internal control reporting to the board of directors says if there's something that is significant, it must be reported in writing to the board of directors. Now, material internal control weaknesses are by definition also significant. It's because significance is a lower level. Here's significant and here's material. So by definition, if it's material, then it's definitely significant. So but anyway, you're reading the standard, a lot of times they talk about significant. Significant is less than material. So by definition, anything that's material is also significant. But anyway, anything that is significant must be reported to the board of directors in writing internal controls. Now, also remember though, we talked about this before, internal controls don't necessarily mean is it the right time? Man, I've been yammering on. Internal controls do not necessarily mean the financial statements are misstated. And generally, for the financial audit, if there is a material weakness in internal control, you do not put it in the audit report. You're reporting on the financial statements. If the financial statements are not, are free of material misstatement, reasonable assurance and all that, that's what you report on. You do not put a significant or even a material weakness in internal control in the financial statements. One, the financial statements may be fine, and two, common sense would kind of dictate that you don't want, if you're auditing a jewelry store and the jewelry store has a material weakness in internal control, they don't lock the door at night. That's not the kind of thing you want to tell everybody. Oh, by the way, they don't lock the door at night, so just walk in there and take whatever you want. So you don't put material weaknesses in the audit report. And the only reporting on the financial statements, the dollar amounts, and any qualitative things like management fraud or something like that, you do not put in the audit report weaknesses in internal control for a financial audit. Okay. Other information. The auditor has not identified an undetected material misstatement in the other information. Okay, I think I know what I realized what I was talking about there, and it is what I thought it was. This is when the audit report goes out. When a company issues the financial statements, they usually do it in what they call an annual report. There's actually two things they do. They do an annual report that they give to everybody. And then they also have a filing with the SEC called a 10K. And the 10K is usually much more involved. It's an annual report is usually somewhere between, say, 50 and 150 pages long. And they have all kinds of information in there. If you look at it, and they'll say, if you look at the audit, well, anyway, if you look at it at the audit, at the annual report for, say, General Motors. You know, they'll say, okay, we make automobiles, we make airplane engines, but I don't even know what they make anymore. But you know, they'll have all these different things that they make, and they'll go through and explain those different parts of the business. And about halfway through, so let's say General Motors has an 80-page annual report. About halfway through, around page 40, you'll see the financial statements, and they'll have the opinion in there, the audit report in there. So the financial statements and the audit report. Sometimes the audit report's first, sometimes it's last, whatever. The financial statements and the audit report are usually about in the middle of the annual report. Okay, now, this can be a problem. What if you have something in that annual report, you know, in the first 40 pages or in the last, 40 pages or whatever, that doesn't match up with the financial statements? You know, suppose in the, on the 5th page, they say that their revenues are 380 million. And you look at the actual financial statements and their revenues are 352 million. What do you do if the information on the financial statements doesn't match up with the other information they're giving? You know, it can be misleading to have your document in that report that clearly states on page 5 an overstatement of revenue. Now, you're not giving an opinion on the entire annual report. You're only giving it on the financial statements, those 5 or 6 pages or whatever in the middle. That's all you're doing. You're doing basing your report on. So one of the things that we always have to check is to make sure that the information given along with it, the other information that's not covered by our audit, that it matches up with the audit itself. So, and what can you do? If they won't change it, you can withhold the audit report. Kind of a drastic measure. You can also refer to it in the audit report. So, those are things that you can always do for the if the information doesn't. So this doesn't match with the okay. I'm sorry. I've been muted here. Yeah, sorry about that. Okay. I'm no longer talking to myself, so okay. Report on other regulatory requirements. Sometimes other places will have different things they have to report to. It could be government agencies or whatever, depending on what kind of company they're in. Okay, key audit matters. Key audit matters are things that are significant, communicated to those in governments. The audit is not required, may not require key, let me pull this. May not require key audit matters. So key audit matters are those things that are communicated. And we always have had those things in the past. We called them emphasis of a matter or other matters that we could always put in the audit report. For whatever reason, they changed it to key audit matters. But those are things that we feel are significant enough that they go into that whoever's looking at the financial statement should know about it. And it could be any number of things. It could be, hey, by the way, you know, this company sells 80% of its stuff to, you know, General Motors. You know, telling them, look, this is a really big client they have. So if there's a problem at General Motors, by the way, it could, you know, could impact you know, our client, whatever. So a lot of times these are things that are put in there. Now there's a similar one. We're not going to go into it in depth now because we got to we'll get to it next time. But when the PCAOB report has a similar thing, but they call them critical audit matters. So it's a similar to this. So key audit matters, and we'll talk about later, critical audit matters are similar ideas that you actually could put things on there that that you think are significant that people should know about for the audit report. Okay, let's stop here. And I know I've been rambling on here. Okay, so let's pick this up next time. And by the way, how much do we have left? Okay. This won't take too long. Okay, so we easily be able to finish this by next week. Okay. Any questions on that? So there's quite a bit in there, and like I say, if you know, like so we talked about today, if you know a lot of that, you could answer actually a lot of questions on the CPA exam and auditing, anyways. You know, just based on what is in that, what's included in the audit report, and that's probably one of the good reasons why we spend so much time going over it is the stuff that's in there is important. The stuff that's not in there is less important. So if there's something that's not in there, it's of less importance than we have in there. Okay, any questions? And I promise I'll get the stuff graded tonight. The stuff that we need to that I didn't grade yet. So I apologize, and I promise that it will be in there tonight. Any questions? Okay, I'll see you next week. And next week is the last regular class that we have, and I'll send out the last test will be on chapters 16 and 17, and that'll be it for the course. So, all right, have a good evening and a good weekend.
Thanks, you too,
You
Professor.
too. Thank you.
Thank you, Professor.